Today, we're diving into the power of diversification, how spreading your investments across assets like stocks, bonds, real estate, and commodities, and regions like the USA, UK, Australia, and Canada can reduce risk and build a resilient portfolio. This is a timeless strategy for investors everywhere. So let's explore it step by step. But first, if you're new here, welcome to Global Finance. I'm your global finance educator based in the USA. Subscribe to stay updated on global market insights and economic trends. Before we dive in, let's quickly review last week's content. Last week, we covered whether 2025 will be a good year for the stock market. You can watch that video here. And don't forget to like and subscribe for more weekly content. Also, please note, this video is for educational purposes only. It is not financial advice. All investments carry risk and may lose value. Please consult a licensed professional before making any investment decisions. Now let's get started. So what is diversification, and why does it matter? Diversification is the practice of spreading your investments across different asset classes and geographic regions to minimize risk. Think of it as not putting all your eggs in one basket. Historically, diversified portfolios have weathered market downturns better than concentrated ones. For example, during the 2008 financial crisis, portfolios mixing stocks and bonds lost about 20% on average, compared to 40% for stock-only portfolios. In 2025, with uncertainties like Fed rate, cut expectations, and global trade tensions, diversification remains a cornerstone of investing. This is a general concept, not advice. Now let's dive deeper into diversification. Let's start by diversifying across asset classes. Different assets react differently to economic events, which is why diversification works. Let's look at key asset classes. First, stocks. Stocks represent ownership in companies and offer the potential for growth. However, they can be volatile as investor sentiment and economic conditions change. The S&P 500 index, a gauge of the U.S. stock market performance, currently sits at around 6,584, showing a gain of 0.79% on September 11, 2025. But remember, stocks have faced ups and downs throughout history. For example, in 2022, the S&P 500 saw a decline of about 10% amid rising interest rates and inflation concerns. That's why diversification is crucial. By including stocks in your portfolio, you can benefit from their growth potential, but you're not solely reliant on them. Next, bonds. Bonds are debt instruments where you lend money to an entity, government, or corporation in exchange for regular interest payments. Bonds are generally less volatile than stocks. During turbulent times, investors often flock to bonds seeking safety. For instance, U.S. Treasuries or UK gilts, a type of government bond in the UK, are known for their stability. While returns on bonds are typically lower than stocks, they can still provide healthy yields. Historical bond yields in the USA and UK have hovered between 2 and 4%. Real estate. Investing in property can be another way to diversify. It offers a tangible asset that can generate rental income. However, it's essential to understand the risks involved, such as property maintenance costs and market fluctuations. Australian Real Estate Investment Trusts, or REITs, are a popular option for investors seeking exposure to the property market without directly owning and managing properties. These trusts own and operate income-generating real estate, and they trade on the stock market like shares. On average, Australian REITs offer yields between 3 and 5% annually. Commodities. These are raw materials or primary agricultural products that can be physical like gold or oil, or more financial like currencies or cryptocurrency. They can act as a hedge against inflation, since their prices often rise when currencies weaken. Gold is a popular commodity known for its stability during uncertain times. For example, during the health crisis in 2011, gold prices surged by nearly 10%. Diversifying with commodities can help smooth out your investment returns. A well-balanced portfolio spreads the risk across different asset types and can potentially increase your overall returns while reducing volatility. Now let's look at global diversification. Spreading investments across different countries or regions can enhance your portfolio's resilience. Let's examine the USA, UK, Australia, and Canada as examples. First, the USA. The U.S. economy is often seen as a safe haven during global uncertainties due to the strength of the dollar and the depth of the U.S. capital markets. Key indices include the S&P 500 and the NASDAQ. However, recent years have shown that even the U.S. market can experience volatility, as seen in 2022, when the S&P 500 dropped by approximately 10%. To balance this risk, investors often turn to international investments, especially in more stable asset classes like bonds. UK. The UK has a well-developed capital market with major companies listed on the London Stock Exchange. The UK is part of Europe, granting access to a broader market through the European Union. The leading index, the FTSE 100, was recently up 0.4%. However, uncertainties like Brexit and fluctuating trade policies with Europe add a layer of risk. Many investors consider adding European bonds to stabilize their portfolios. Australia. The Australian market is closely tied to global trade and commodity prices. Major companies in sectors like mining and banking drive the All Ordinaries Index, which gained about 5% in 2025. However, reliance on a few sectors poses a risk. To diversify, investors often incorporate global ETFs to broaden their market exposure beyond Australia's borders. Canada. The Canadian market, heavily influenced by the energy sector, is closely linked to oil prices. Key indices include the S&P/TSX Composite Index. Oil's volatility introduces uncertainty, especially with geopolitical tensions in oil-rich regions. Diversifying with investments in the U.S. or emerging markets can help mitigate risks. In conclusion, diversification is a fundamental strategy for building a resilient investment portfolio. By spreading your investments across various asset classes and global regions, you can reduce risk and enhance your portfolio's stability. Whether you're a long-term investor or just starting your journey, implementing diversification principles can lead to a more balanced and potentially profitable investment strategy. Remember, diversification is a journey, not a destination. Regularly review and adjust your portfolio to align with your financial goals and risk tolerance. Keep learning and stay informed about global market trends and economic shifts as they can influence your investment decisions. Stay tuned to Global Finance for more informative content, and do not hesitate to share your thoughts in the comment section below. And of course, this is just general knowledge. Your actions should be discussed with your licensed professional. Now let's move to our last section, looking at 2025 context, why diversification matters now. The year 2025 presents unique dynamics that highlight the importance of diversification. As we mentioned earlier, the Federal Reserve's policy decisions can impact not just U.S. markets, but also global financial markets. Currently, there are expectations of a 25 to 50 basis point rate cut by the Fed during the upcoming meeting on September 16th and 17th. Such a move could boost stock values as liquidity increases in the market. However, it would simultaneously put pressure on bond yields, affecting fixed income investments. Additionally, global trade tensions, particularly those involving Asia and ongoing tariff talks, introduce uncertainty. If trade routes become more disrupted, Australian exports, for instance, could face challenges. Moreover, with Brent crude oil hovering around $67 in 2025, Canadian oil producers might experience volatility due to price fluctuations. Diversification becomes crucial in such times because it allows investors to balance exposure to these volatile areas. Holding U.S. stocks alongside Canadian gold or UK bonds can help offset potential losses in specific regions. For example, during times when the oil price falls, the Canadian market might suffer, but a diversified portfolio with exposure to other sectors or asset classes can cushion the impact. In conclusion, in the current context of 2025, diversification is essential for building a robust portfolio that can withstand uncertainties related to monetary policies, trade tensions, and commodity price fluctuations. By spreading investments across different asset classes and regions, investors can mitigate risks and capitalize on diverse market opportunities. Thank you for watching. See you next time.